And as we keep talking about the big story of the morning, semiconductor, Nvidia planning to resume sales of a key AI chip to China. The company saying it's filing applications with the U.S. government to restart sales of its H20 graphics processing unit and expects to get the licenses soon. Nvidia has been saying that it introduced a new model designed to meet Chinese tech regulations. Now, Chinese tech stocks popping on the back of this news. The development's coming days after Nvidia's CEO Jensen Huang meeting with President Trump back in April. You might remember the White House imposed export restrictions that stopped Nvidia from selling the H20 to China. The move at the time prompted the company to write off $5.5 billion in inventories. Huang is currently on his second visit to China in about 3 months. He's now expected to hold a media briefing tomorrow. But, of course, this raises just about 1 million questions because the first one starts with what happened between April and now. If these chips really were a national security threat to us, why should we be giving them over now?
Well, nobody knows.
Is it part of a larger trade negotiation truce with rare metals and other things? And we need, we need the metals. They need the chips.
Or TikTok.
Or TikTok. Or tariffs.
We're all trying to find our way into what the right balance is between, helping AI advance and not having China lead the world.
Well, so that's the question. And by the way, if you let NVIDIA do this, maybe that then hurts like a Huawei temporarily, or something like that.
Huawei,
I mean, that's why there's so many sort of push-pulls here.
Yeah, there are, and I don't know, and I'm not willing to immediately say, wow, Jensen's friends with Trump, and this is a carve-out and whatever. Because I don't know what the right...
There's a huge view that's been not only put forth by Jensen, but by a lot of other people in the industry, that if America wants to be the leaders, you have to be able to sell around the world, that Huawei stepped in to fill that void. Look, there's the argument that this is great for America in terms of leading AI, but there's also the argument that if it was so great for America, China wouldn't want to let them do this unless they actually thought our chips were that much better. So.
Right. And so the question, our chips are that much better.
Yeah.
And so they wouldn't have access to these chips otherwise. And Huawei chips are not as good yet. The great mother of invention is forcing Huawei.
Sure, but you can't continue to be the world leader if you can't sell everywhere.
Well, except into China. I mean, if you think one day that Huawei would create chips that are that great, but right now...
And by the way, these are different chips. The H20 was originally created to try and make sure that it was not going to be able to do some of the terrible things militarily that others had pointed to. So that's the question.
The only thing that I don't understand about this is we've had so many people come on our air repeatedly and say, China's a national security threat to our country. These chips present a security threat. If we let them actually move ahead and be able to dominate or even get close to us in AI. And I think DeepSeek, if everybody remembers that moment earlier this year, frankly, at the end of January.
It was February, I think. End of January, beginning of February.
It was January because it happened during Davos.
We're obviously not going to stop all trade with China because they're a security threat. So then somewhere in between is some type of trade relationship we have with China.
I'm not going on the friend of Trump thing either. I'm just saying, what is the...
Who knows? I don't know.
What is the balance?
We probably shouldn't have any. Kyle Bass and others would probably say don't have any relationship.
Well,
others like
again brings you back to
your buddy Paul Tudor. No, who's the one that just loves China? One of those guys is Ray Dalio. He's give them everything they've ever asked for just to make a few more dollars. There.
I mean, the real question I want to know is what are we going to get for this?
Right, I think if you're talking security threats, it brings you back to TikTok, which Congress passed a ban on, and we are now months into extensions of saying, okay, we're going to continue to try and do a deal with them. But there have been people for years in Congress who have said that TikTok is a threat to national security because of the influence that it has, especially on younger people here.
A $5 trillion market cap and a continued rally in the NASDAQ.
It's not $5 trillion yet, it's right. It's $4 trillion.
No, and that's
I said, what do we get for it? And I said, that's what we get. Maybe we get a $5 trillion market cap and a NASDAQ that continues to climb.
But I think Becky's point about TikTok is the right one, ultimately, because we have a law even in place. I mean, we have actually Congress have voted.
No one wanted to close TikTok down, right?
Apparently, all of Congress who represents us.
Not really, though.
Legally, they did.
Well, they didn't want Chinese ownership. They wanted it to be sold. So they didn't want it to continue under Chinese ownership. The question is, do you get a sale of that? Is there some détente or truce? And is this a sign of a broader thawing of the trade relations between the two countries at this point, too?
China's here to stay. They're going to take over the world, and we're helpless to stop them, but we've got to trade with them.
That's your position?
Yes.
Why don't we start with the big market story this morning? Nvidia shares moving higher again on that news that they can sell their H20 chips in China. What does that say to you about the broader tech sector, the fact that we're seeing other chip stocks move higher on that news as well?
Well, I mean, I think it says that we have more room to run on this trade, on the AI trade overall, but probably still actually a little bit more on the semiconductor trade, more than we actually thought that we were going to coming in this morning before this announcement. We thought we were going to be moving on towards more of a broadening of the AI theme, but we may get a resurgence of more of the infrastructure part of the AI theme here for a little bit.
Yeah, we had to hit on that again. Nvidia, the biggest leader in the S&P in the pre-market, shares up about 4.5% right now. I want to go back to that B of A survey very quick, noting that sentiment's getting a bit toppy, but people have a bit more appetite for risk. How do you see that playing out?
Well, I mean, sentiment getting toppy is interesting, though, Frank, because sentiment was really bombed out as recently as about 2 months ago. So it is rising pretty quickly. It's risen, especially on the professional investor side, but it was rising from a really low starting point there. I mean, people were really pessimistic on the professional investment side here about 2 months ago. So it's probably just a recognition of the fact that we are getting some trade. We're going to probably start getting some trade deals here pretty soon. It looks like there's room for negotiation. Trump opening up these chips to China is showing that he wants to even deal with China, and he's continuing to talk to Europe and everybody else. And so it's like as we progress along through this, through some of these themes that were holding investors back here for a while, including like we're going to get the big beautiful bill passed, or we're going to get trade deals. These things were really kind of holding us back. We're getting some of that stuff resolved, and so just a kind of normalization of investor sentiment is probably a normal reaction to something like that.
What I thought was pretty interesting in that survey is that the fund survey report says that they see investors kind of rotating sectors. So we know that industrials are the leading sector. The industrials seem to be feeding off some of that tech optimism and AI optimism as kind of the picks and shovels play when it comes to there. Do you see people rotating away from industrials, and where do you see that money going?
Well, we see probably a little bit more broadly than industrials. We see people actually probably starting to rotate a little bit into infrastructure plays, Frank. The infrastructure play is not just sort of your mom and dad's infrastructure plays. This is going to be kind of AI delivery infrastructure plays that, in terms of power generation, power delivery, everything that goes into making AI one of the central themes of the economy for the next 25 years, much as, the internet PC boom was has been the central theme of the economy in the U.S. For the previous 25 years. That movement into sectors of the economy that can really take advantage of that theme, as we think is going to be the kind of the future story.
That B of A survey showing a lot of optimism. Can I bounce something else off of you that came from Morgan Stanley Wealth yesterday? It's a bit long, but just bear with me because I want to see if you have a take on any part of this because it hits on a number of things. This is from Lisa Shallett from Morgan Stanley Wealth. They say they see the S&P 500 gains beyond the 6,500 to 6,600 range as difficult to achieve. They also say they're unconvinced the dollar weakness is purely benign, given amplifications of tariff impacts. You were just talking about tariffs. And then furthermore, they say they're skeptical that the tax code changes net pay-fors are stimulative enough to prompt the new investment boom, and also say operating margins may be elusive as accounting mechanics, demand destruction, tariff absorption, and commodity gains thwart upside earnings surprises. As we go into earnings season in full swing with the banks today, any of those points, did any of those stick out in your mind as possible headwinds to the markets moving higher?
I mean, how long you got, Frank? That is. There's a lot to unpack in there. I disagree with almost every word of that. To be perfectly frank. As far as the dollar goes, the dollar is facing some modest headwinds, but it's nothing, it's nothing, disastrous. The margin story, I think I couldn't disagree with more sharply. The margin story is really driven by productivity gains, and productivity gains is driven by tech. And we're still in the cusp of one of the biggest tech booms that we've seen in the last generation. And so, that we think is complete folly. And as far as like generating gains past 6,500, 6,600, it's something that we can probably sustain. I mean, I don't think we're going to have a 25 or 30% year here in the United States, but this is also going to be a negative 10% year. So I just think it's really we should be really careful to get too bearish as we're coming into this earnings season. As we're going to start hearing from some of the banks this morning, and we're going to get a clue as to what the consumer is really actually doing, what our businesses are really doing with this added certainty that we've gotten from the passage of the big beautiful bill. And some of the reduction.
I just want to start off with this news. The idea of Nvidia again selling those H20 chips into China. We've had Dan Ives from Wedbush on. He says the demand for Nvidia chips in general. I know you guys don't buy those H20 chips; those are for China. But the demand for chips in general has been amazing. He believes there's 10 people that want a chip for every chip available. Can you give us just a state of affairs when it comes to chip demand right now?
Yeah. Artificial intelligence, especially generative artificial intelligence, is driving much of the growth of AWS and Amazon Web Services. So we are the largest and most actively used cloud out there. And much of our growth right now is being driven by demand for AI chips. And I suspect that will continue for the next several years because people are training new models, they are building agents, they're trying to solve problems, and it's exciting times to be out there for the chip business and artificial intelligence in general.
Now, as you mentioned, AWS is the market leader when it comes to cloud infrastructure. I would imagine you'd like to hold on to that leadership. So you're making an announcement, the fact that, English is the quote-unquote lingua franca. I know it's like, I believe it's Latin.
Latin.
The lingua franca of software development and things like that. So you have some new tools coming out today so that people can develop in all languages. Kind of explain that.
Yeah. So if you look at how people have built software for the past 30, 40 years, they write software in Java or C++, some programming language, and you have to learn that language and how it interacts with the computer to make it do what you want. In the AI world, that's not how you're writing software. You are giving it instructions in natural language. You are asking it to build a website that looks like it's blue in one corner, not giving it specific instructions. Anyone can learn a programming language, but if I am, say, a developer in Korea and I want to give instructions to an AI agent, I would rather do it in Korean. It's my native language. And what we are doing is making sure that wherever you are, programming is a global, is global, and software development is global. You can give instructions to your agents in whatever language you choose to, and get responses back in that same language. So that's why we are investing in that.
This is an interesting idea, specifically tied to China and maybe some other countries out there, BRICS nations. Why do they want to go to AWS for infrastructure? Why aren't they going to a sovereign AI or infrastructure domestically? Why do you think this is going to attract them? Because it seems like more and more we're seeing different countries, nation blocks like the EU, they want to keep all their data, domestically housed.
Yeah. So two parts to this. One is AWS has now 20 years of expertise building and running applications in the cloud. And people have trusted us to do that for a very long time. And they trust us to do that with AI applications as well. We've also understand and listen to our customers on what their data residency demands are. So, for example, we have announced the European Sovereign Cloud, and where we have very strict governance around how data is managed, who manages it. And that makes our customers very comfortable, even when these requirements come up. And we continue working with governments and regulatory bodies and how we can help them do that.
We've reported on some of that news about some of these different sovereign clouds, but I think the other side of the coin I want to ask you, are there limitations on those sovereign clouds as opposed to just being on the public AWS cloud? If you're perhaps like a French company, Mistral, why would you want to be on the European cloud? Does that limit in any way, or is there any advantage to being on that cloud as opposed to being on your regular public cloud?
There's no difference from how the infrastructure is built, how it's run, what's managed, what's available. It's all the same as we do in the public cloud. It's how it's governed, who's operating that infrastructure, how is data access managed. Those are the assurances that we give customers, which makes them comfortable using those clouds.
All right. We also have some news coming up later today. The president expected to announce about $70 billion in AI and energy infrastructure, funding. Is AWS playing a part in that in any way?
We work very closely with the U.S. government and other governments on how we can contribute and be part of these infrastructure spendings. I don't have anything specific on that one. But the area that we continue to work with the government here and elsewhere on is how do we make sure that we understand what the policies are, how we can participate, and make sure that customers get a great experience building AI agents and AI applications.
Joining us right now for his take on the markets is Mike Wilson. He's Chief Investment Officer and Chief U.S. Equity Strategist for Morgan Stanley. And Mike, it's great to see you.
Morning.
Before we talk more broadly, can you just comment on Nvidia, what that means maybe for tech companies writ large?
Yeah, I think this is back to the issue we've been dealing with. Is like what's going to be sanctioned, what's not going to be sanctioned. I mean, the 232, like what's going to be carved out. So this is a step in the right direction for semiconductor companies broadly, I would say. And let's not forget that they took a large write-down for those same chips.
$5.5 billion just a few months ago.
And now apparently they can sell them. So that's going to be a huge positive kick to margins, going forward. And look, one of our big themes this year as we came in was that AI CapEx was going to slow, decelerate, and then all of that troughed in April. And I think that explains a lot of the sell-off in the first quarter and a lot of the recovery. It doesn't get a lot of attention, though. People are focused on tariffs, they're focused on other things that are going on. But the AI CapEx cycle has been very important for the overall market direction, first down in the first quarter and then the recovery in the second quarter. And this deal or announcement, I think, is just more fuel to that fire.
What do you think overall? I know that you believe the One Big Beautiful Bill was very positive to have that passed, and I think you are writing off a lot of the worst headlines for tariffs at this point, too.
Well, that's right. I mean, I think we had a lot of bad news in the first quarter. Once again, there were many headwinds to growth. A lot of those, some of those were policy driven, some of those were not policy driven, and they all seemed to sort of bottom in the April period. So the market has moved on from tariffs as the worst is behind us. It doesn't mean that we don't still have bad news or issues in front of us, but it's moving beyond that. And the Big Beautiful Bill did sort of wrap up a lot of the things that are now going to lead to positive things for earnings growth, both in the second half of this year and into next year. So as we said at the beginning of the year, President Trump came in, he's like a new CEO. They kitchen sink things, right? They did all the growth negative things first. And I think the Big Beautiful Bill is part of that positive transition now to really earnings growth more so than economic growth. And I think the market understands this. This is why people are very confused about why is the market up? Why is the market up? Well, earnings revision breadth has turned straight up. And we've been talking about this for 3 months. And the Big Beautiful Bill only supports that view further.
Earnings, we're just starting to hear the first of the banks reporting now. I think earnings growth of 3 or 4% is anticipated overall. You think it's going to be better than that or not?
Yeah, I mean, these companies manage these earnings, so I'm very confident they'll beat by 4 or 5% as typical. And here's the key for earnings. I think the first 2 quarters we didn't see the impact of tariffs because companies sort of pre-bought a lot of goods, and so we're not seeing the flow through to the cost of goods sold. If there's going to be an earnings risk story, it's probably in the third quarter, but it's back-end loaded. Financials don't have impact from tariffs, right? It's going to be in the consumer goods space, and those companies tend to report in the back half of the earnings season. So I think August is going to be the period where we could have some sort of corrective activity around the earnings, but that's a pause because my view is that earnings are going to reaccelerate in the fourth quarter and into 2026.
Mike, you know, President Trump is he does things that are unexpected. Some people think that's a benefit with our enemies not knowing what the heck he might do at any time. But one thing that seems consistent is if Jensen Huang goes to him and says, look, NVIDIA is going to be severely hurt if we can't do that. Or if Tim Cook goes to him and says, look, if we can't build our iPhones right now in the United States without them costing, he seems to be, you can talk to him, and if it's about business and about companies succeeding, even with tariffs, I think if the big three come and say, look, you're doing this, you got to carve this out for us if we're getting seats from Canada. He seems to err on the side of trying to help businesses. Can we count on that? That would be nice if we could count on that.
Well, I think we've learned that over 2 terms now, right? I mean, then the market is onto this idea that, yeah, it's a negotiating strategy to go way over here, and then there'll be carve-outs, right? And things like rare earth metals, right? It's another one, and the magnets. I mean, that's another one where they're making concessions.
No one really wanted to deprive everyone.
Well, so then the question is, from when it comes to tariffs, what do you think we ultimately get or not?
Less.
And by the way, though, if we all know this, don't our trading partners know this too?
And then they don't negotiate.
They do, but
don't they look and go, this, right?
Yeah, but that's why I think the market is saying that we're going to settle somewhere in the middle. So my view personally has been for a while that this is going to end up looking like a 10% consumption tax, sort of like a VAT. And the idea there is that it'll be shared between exporters, importers, and consumers kind of equally. We can live with that. And that's where I think the market has settled on. Could I be wrong about that conclusion? Sure. Could there be situations where it's a little bit worse, perhaps maybe with Vietnam or some of these other countries, maybe even China? But at the end of the day, if we can collect 10% tax on all imports, that's $400 billion a year. I mean, that's real revenue, right? I think that's the goal here it's a revenue generator. Okay, we can live with this. It's a shared tax across those 3 constituents, and businesses will figure it out. And I think that's why the market it's not complacent. It's just that's where it's settling.
The tech sector just got a major boost, and once again, Nvidia is at the center of the story. Reports suggest Nvidia's H20 AI chips, which were previously under regulatory pressure in China, are now back on the market. That's big, not just for Nvidia, but for the entire semiconductor industry. After a major write-down just a few months ago, being able to sell those chips again could provide a serious lift to margins. Naturally, the Nasdaq responded, rallying sharply, led by tech and semis. And with AI at the core of nearly every major growth story in 2025, this shift is being taken seriously. Scott Loudner, CIO at Horizon Investments, says we're seeing a second rotation within tech. The first wave was all about software and AI models, but now the focus is shifting to infrastructure. The companies that power AI, chip makers, data center builders, advanced hardware suppliers, are there taking the spotlight. In his words, AI is real. It's not just hype. And that's what markets are starting to price in. Capital expenditure is rising. Companies are building fast. From cloud architecture to high-performance GPUs to massive server farms, demand is ramping up. That's not just good for Nvidia, it's good for every company tied to AI infrastructure. Now, let's bring in Mike Wilson from Morgan Stanley. His take adds more depth to the conversation. Wilson notes that Q1 saw a dip in growth, largely due to a slowdown in CapEx. But by April, that cycle had bottomed, and what followed was a strong recovery in equities. Investors have been focused on tariffs and politics, but Wilson believes the real story lies in CapEx momentum. As investment returns to tech infrastructure, the broader market gains strength. It's that simple. Now let's talk policy. The so-called Big Beautiful Bill, recently passed, has cleared up several major headwinds. That legislation, combined with de-escalation in tariff threats, is providing more clarity and more confidence to corporate America. As Wilson puts it, the market has moved past the worst of the tariff fears. That doesn't mean challenges are gone, but the narrative has changed. The U.S. economy is transitioning from policy-driven uncertainty to earnings-driven growth. And that's a key distinction. It's not just about economic recovery anymore. It's about corporate earnings, growth, margins, and performance, especially in the back half of the year. Wilson points out something interesting. In the first half of the year, companies front-loaded inventory, so we haven't yet seen the full impact of tariffs on consumer goods. But as we move into Q3, especially August, we may see some noise in earnings reports, particularly from consumer-facing businesses. However, financials and tech, the two largest sectors, remain largely unaffected by direct tariff costs, and that's good news for the indexes. Looking toward Q4 and into 2026, Wilson is bullish. He expects earnings to re-accelerate, driven by improved policy clarity, stronger margins, and renewed business investment. Now, let's address the Trump factor. Love him or hate him, one thing that's clear is his unpredictability. And in the world of global trade, that has both risks and opportunities. But as we've seen when top CEOs like Nvidia's Jensen Huang or Apple's Tim Cook go directly to the president, they often get results. Trump listens to business, and when they explain how a policy may damage U.S. competitiveness, carve-outs tend to follow. Wilson explains that Trump's strategy often involves negotiating from extremes only to settle in the middle. And that's exactly what markets are pricing in. Ultimately, he sees this evolving into something like a 10% consumption tax shared between importers, exporters, and consumers. And here's the kicker. That could generate $400 billion a year for the U.S. government. Is it ideal? Maybe not. Is it manageable? Absolutely. And markets can live with that, as long as there's clarity and predictability. So where does this leave us? Tech infrastructure is no longer a behind-the-scenes story. It's front and center. Nvidia's return to the Chinese market sends a clear signal. AI demand isn't slowing, and the companies enabling it, from chips to power to data, are leading this next wave. Capital expenditure is up, earnings are stabilizing, and policy clarity is improving. For U.S. investors, the focus now is on positioning for real growth, not just hype, because AI is no longer just a buzzword. It's a full-blown economic driver. Stay tuned. The second half of 2025 could surprise